Welcome back. You're watching Wealth Manager. Let's talk about the alternative investment space. Research done by Anand Rathi shows that both real estate as well as PE funds have given returns as low as 5 to 6% over a 10-year period. For more on this, I'm joined by Feroze Azeez of Anand Rathi. Thanks, Feroze, very much for joining in today. So let me start. You've analyzed about 16 funds, 8 private equity and 8 real estate. Take us through what the research has really thrown up.
See, we were very curious to know, especially after finishing 10 years of this industry. The first private equity fund or a real estate fund more so came in 2005, 2006.
Right.
In the largest scale, of course, there could be small funds, but the prominent ones started in 2005, 2006. So we were very curious to know what has been the output so that we understand whether they are worth recommending or not. And the research was startling. Like you just pointed out, 5 to 6% per annum return is what they actually have been able to generate. 16 funds is a lot of funds, and these are not the small time funds. These are funds which are large assets, cumulatively have about 11,500 crores of assets, which is almost a representation of more than 50-60% of the industry itself, and from large fund houses. Point one, large funds analyzed very low returns vis-a-vis what was projected. Point two, there's an opportunity cost to money, which is what a HNI, if we wouldn't have invested in these 16 funds, would have invested somewhere, maybe a simpler product like a mutual fund, which is a significantly larger industry. If you would have invested in equity mutual funds, the same 11,500 crores, which has currently become 15, could have gone to a whopping 23,500 crores. So that's a 8,500 crores of value destroyed for these investors across 16 people. That was one of the most startling data I have seen during my career of 12, 15 years. So, and the other thing is, if you actually, even if you said that I would have invested in a debt fund, half the money and half the money in equity fund, you would have these investors
made more, right?
7,000 crores could have been, these investors could have been richer by 7,000 crores. Point number three, we also discovered that all these funds, unfortunately, have extended the period. Okay. Generally, these funds used to come with 7 years plus one, and the 1 year extensions were an exception, but by and large that became the rule, and everybody seems to be extending it.
So Feroze, how were the funds really chosen? On what basis did you choose these particular funds for the study?
So there were three parameters on which you choose these funds. One is the backdrop of the manager or the promoter of this fund management firm. So we wanted to take large fund houses, not take small ones, because that will give distorted figures. And the second, which is very important, is the assets which they manage. See, if there's underperformance on 1,500 crore fund, then there are more people suffering there than a fund which is about 100 crore fund. So these were the two large parameters. Of course, the third parameter was, of course, the pedigree or the lifespan of the asset manager in this business. So one is the promoter of the company, the manager, who's the individual who's trying to manage it, who had enough backdrop in terms of credibility already on paper to see whether the credible people have been able to perform. And the third thing was the assets. These were the three things considered.
So in your opinion, again, what has really caused this underperformance? Do you think it's just been bad fund management, or what are the reasons for that?
See, we tried to introspect and figure out why such a significant difference. Now what happens is, for example, if you look at real estate, okay, if there are funds, and you would see that last 10 years in real estate in India haven't been too bad. Okay, in a good market, if the real estate funds, these funds have given 6%, there has to be something which is beyond just the real estate market's performance. It is basically because of the larger quantums of money. The fund manager is not able to deploy a lot of monies in lucrative deals, because if the sizes are too small in real estate, it becomes very difficult. If the sizes are too large, it becomes very difficult. The medium size funds are what size is one large reason why real estate funds would have underperformed. And real estate is a very unstructured market in which you're putting a structure, it becomes counterintuitive. So that's one reason. And the private equity space, what's happened is private equity exits, private equity market itself has been very, very lackluster, and listings are not happening. The IPO markets over the last 3-4 years have been really bad. So all what the investor looks at is the brighter side of it. It'll look at the Flipkarts of the world, all these unlisted stocks which have done very well and added value to people. But there are hundreds of those companies which don't see the light at the end of the tunnel. So that's basically the IPO market and this whole unlisted space has not been able to kick off. These were the two large reasons, and of course bad management of money and very fee driven. Now what happens is a fund, once it exits and pays back the money to the investor, he has to stop charging fee on that money. So that becomes a very large deterrent for a fund manager to part with his monies, which he has collected for 7-8 years in 3-4 year periods.
Okay. So tell me one thing, why then are people still attracted to these funds? Because the AIF space today seems to be growing, quite rapidly, and the estimations are that it's going to continue to grow going forward. Given that the fact that your returns are not good, the commissions that as an investor I pay are much higher, you have to fee sharing, the profit sharing model as well. Why are people still attracted to these funds?
See, what happens is, in April this year, the last year, I mean, this financial year, SEBI actually clamped down on mutual fund commissions big time.
Exactly, yes.
And there was a large drop of almost about 40-50% in terms of what one could earn in mutual fund commissions. So these funds actually offer 4 to 5 times more commissions than a mutual fund does. So a distributor generally is very attracted to pick up money in assets like these, which have 3-4 categories of fees. Like you said, a profit share is there, a management fee is there, and there's so many other kinds of administrative fees. So these fees come back to the distributor in the form of commissions for him. So I would say the largest driver of asset growth in these categories and also in portfolio management services is predominantly a fall in fee in the rest of the core category of mutual fund, and these end up having 5-7%, sometimes even 10 times more the fee than a mutual fund. So a distributor is very lured to take a 50 lakh rupee check in this. AIF has a minimum 1 crore now, 1 crore rather than taking a 10 crore check in a mutual fund. Now that's a large whopping greed invoke in the distributor.
So you're saying that it's simply because it's being pushed that much more by distributors that people end up buying it more?
So unfortunately the answer to that question would be yes, in my opinion, because the performance definitely doesn't merit any of HNI money going into this unless the tide turns for 2-3 years and then you see that okay, these guys are back on track, and then you could probably participate, because you will always have these AIFs coming through, so there is no hurry for an investor.
What is your advice to investors who are looking at AIFs, and what is your view on the AIFs that we're seeing that are coming out today in the market?
See, what happens is alternate investment fund, like I already mentioned, is a larger canvas. So it would be wrong, incorrect on my part to generalize and say none of them are actually good. So you have to be very careful when you pick an AIF. Anything which does not have liquidity on your side, don't touch that AIF, come what may. If liquidity is still there, so that you have something to backtrack and change course if things go wrong. Unlike in these private equity real estate funds, when a person was stuck, his agreement kept him tied for 8-9 years. Apart from that, you should make sure that you don't hurry up into an AIF, because there is a lot of complexity. In my opinion, complexity has always turned monies into a guinea pig kind of a situation where you're experimenting with the money. You would rather stick to the trusted, proven track record kind of asset classes which are there in the industry. So I would say that you have to be very, very cautious and not just get carried away with the exotic nature which this provides, which of course seems interesting, but what ends up mattering is the money you make in it, and generally if you're enjoying the process of investing, you're not making money. So this definitely gives you the joy of investing but not the money of it. So
so essentially you're saying just stay away from AIFs.
Be very, very cautious. There are some AIFs which are liquid. They don't invest money necessarily in unlisted equity, they invest in listed equity. They use derivatives for hedging and alternative purposes, which might be a very, very good idea. So I would not want to say all AIFs are a bad bargain. There are some which are very good. So evaluate them very cautiously. Anything which has a lock-in is certainly not worth giving away your liquidity for.
All right, we'll leave it there. Thanks very much, Feroze, for joining in. All right, time for another quick break. We'll come back with a real estate segment, Realty's Best Bets. Stay tuned.